Every time a new millionaire pops up in the news, it's the same old story. Some crypto kid who got lucky, or a tech founder who built an app in their bedroom. And honestly, after 10 years as a financial advisor, I find that kind of hilarious, to be honest with you, because the actual millionaires sitting in my office in front of me, they're not on the front page of anything. They're deputy head teachers, they're marketing managers, they're regional sales reps, people who probably have never earned six figures in their whole lives. And yet they're retiring with more money than most people think is possible on a normal salary. So the question is, how does someone in a regular 9 to 5 actually build wealth up to £1 million in net worth? That's exactly what I'm going to walk you through today. No lottery wins, no side hustles, no crypto gambles, just a boring, brilliant system that works. And the difference between knowing this and not, it's not like a couple of grand. Over your career, it's hundreds of thousands of pounds. Money that was always yours, just sitting in the wrong place. And it starts with something that most people just get completely wrong. What being a millionaire actually means. Because when most people hear millionaire, they think, someone with like £1 million sitting in a bank account, but that's not really how it works, is it? Not even close. A real world millionaire on a normal salary, well, their wealth is spread across mainly three different things. Think of it a bit like a three-legged stool, for instance. So, leg one, their pension. Usually this is somewhere between like 400 and 600 grand. Leg two, equity in their home. The bit that they kind of actually own, not the mortgage bit, obviously. And again, that's probably roughly somewhere between 300 and 400,000. And leg three, their savings and investments, around 100 to 300,000. Now, importantly, notice what is not on that list. No rental property empires, no angel investments, no day trading account. Just three simple things available to basically everybody in the UK. And here's what might surprise you. If you own a home and have a workplace pension, you have probably already got two legs to this stool without even knowing it. The question, though, is whether you're doing them well enough to actually get there. Let me break it down, because when you see how this kind of works all together, you'll realize that this isn't about just earning more. It's about being smarter with what you've already got. So, pillar number one, your pension. This is your absolute secret weapon, right? Let's start off with the arguably the biggest leg of the stool. This, to me, is your wealth building secret weapon. And it's the one that most people completely ignore. And if you're like most people, you probably just see this as like a boring deduction on your payslip every month, but never really think about what's going on. But here's what nobody tells you. It is genuinely the most powerful wealth building tool that you'll ever have access to. And right now, you are probably leaving a fortune on the table without even realizing it. Let me show you what I mean. So I had this client, let's call him James. I don't know, pick a name, James. He was earning good money, but he had a quote unquote normal job. And he was saying to me that he was like, I don't even really look at my pension. It's just there. It just exists. So one day I sat him down and showed him what was actually happening with his money. And his face, honestly, it was like watching someone find like a £20 note in their old jacket, except it wasn't 20 quid. It was hundreds of thousands of pounds. Here was what's going on. So James had an employer contribution matching scheme. So what that meant was for every pound that he put in, they would match it. So in this case, he would put in 250 quid a month, which automatically became £500 into his pension, because that's the matching, right? But here is where it gets even more crazy. Because he was using salary sacrifice, he wasn't paying income tax or national insurance on any of that money. So that £500 going into his pension was only costing him out of his pocket each month about £145. That was what he basically had to give up out of his take-home pay. So how is that the case? Well, not only, of course, is it the employer matching on top, so that £250 on top, but because the money, his £250, goes into his pension before he pays any tax and national insurance on it. So think about that, right? He is getting £500 worth of money into his pension and invested for only 145 quid out of his pocket. Like, there's nothing else that even comes close to matching that. It's like walking into a shop and like everything is like 70% off. Before his money has even touched anything, it's already up 240%. Now, just a quick one on this before we move on. From April 2029, I think it is, national insurance savings on salary sacrifice is capped at £2,000 a year. Now, that's not a big issue. It's not really as much of an issue as people think it is, because income tax relief and employer matching will still apply. So it's basically kind of just as attractive as ever after this, but it's worth noting that that is something that's going to happen. Now, over a 30-year career, that method is how you end up with a pension pot north of £500,000, not from some genius stock pick, not from some amazing investment, from understanding what's already being offered to you and just maxing it out. So here is your homework. It's going to take 5 minutes of your life. Log into your pension provider's website, or just ring up HR or email HR and just ask one simple question. What is the maximum amount of matching that you will do if I increase my contribution? That one email or phone call could be worth over 6 figures over the course of your career. But there's one big problem with this plan, isn't there? And some of you might already be there ahead of me. And it's the reason why pensions alone are often not enough. Pension pillar number 2, stocks and shares ISAs. So with pensions, here's the catch. You can't touch it until you're 55. And that's actually rising to 57 from 2028. And look, life doesn't wait, does it? Maybe you want to retire early, before age 55 or 57. Maybe you need money for something big before then. That is when a stocks and shares ISA comes into the mix. And right now, genuinely, ISAs are more important than ever. The government has slashed the amount that you can earn tax-free on investments that are held outside of ISA down to £3,000 a year of capital gains. And on dividends, that is just 500 quid a year. So if your investments that you hold aren't inside an ISA, you're basically handing money to the tax man for genuinely no reason. You are probably looking at these figures thinking, well, that's quite a lot of money. I don't get paid that much. But things like the dividends allowance, if you just hold a regular investment account, if you've got 20 odd £1,000 held outside of an ISA, maybe more, you're probably going to be over that dividends allowance and you're going to have to pay a little bit more tax. So what does an everyday millionaire do instead? Well, it's something beautifully boring. They set up a direct debit, let's say for this, in this example, 400 quid a month, into a stocks and shares ISA. And again, that's well within the £20,000 annual allowance. Then what they do is they just forget about it. The money goes in every single month. When the market's high, their £400 buys fewer slices of their investment. When the market crashes, their £400 buys more shares. It's automatic, it's boring, and it just works, essentially. But just how well does this work? Well, let's run the numbers. Now, let's say that you have just saved £400 a month into your cash savings account. After 35 years, you would have roughly £168,000. Basically, what you put in, maybe with a little bit of interest on top. But here's what happens when you invest instead. If someone starts putting the same £400 a month into a stocks and shares ISA at age 25, age is irrelevant, it's more to do with time, but assume age 25, and we assume a careful 6% real rate of return after inflation, after 10 years, you would have put in £48,000 and your pot would be worth £65,500. That's £17,500 that the market has given them for free. Not bad, but it's about to get a lot more interesting. After 20 years, they would have put in £96,000, but the pot would be worth £185,000. Now we are talking. But here's where it gets good. After 35 years, the same £400 a month, no changes to that scenario, you would have contributed £168,000. But the pot value that you have after 35 years is now worth £570,000. That extra £400,000, you didn't earn it. They didn't earn it. That is extra money that has made money of its own. It's crazy, the power of this sort of stuff over time. So really consider the power of cash versus investing. Now, right, before we go any further, let's just take stock of where we are, because this is where it sort of starts to click, right? Pension, potentially £500,000 or more over your lifetime. ISA, potentially another £570,000. Now, of course, not everyone will max both of those out, but even if you get halfway on each, you're looking at over £500,000 with just that alone. And you haven't even counted the next bit, which is your home. Here's the thing though, a lot of that is locked away for decades. So what about the wealth that you're building every single month without even thinking of it as an investment? Which brings us to the third and final pillar. And for most people, it's hiding in plain sight. Pillar number 3, your home. Now, not as productive as the other two pillars, but if you're looking to just build your net worth, thinking about how you can do it via your primary residence, it's actually quite useful. Now, everyone in the UK is obsessed with property, right? But the 9-to-5 millionaire, they're not flipping houses or building some buy-to-let empire. They are just doing something much, much simpler. They're just paying off their mortgage. Every single month you pay your mortgage, part of your mortgage payment goes towards paying the interest, and that's the cost of borrowing. And the other part, that's down to actually paying the debt, building equity in your home. It's like a kind of forced savings account that you actually can't raid and dip your hands into. So here's a quick example. Let's say someone buys a £250,000 house at age 30. They put down a 10% deposit. Let's say they take out a 25-year mortgage. So by 55, the mortgage is done. Even if that house only grows by a modest 2.5% a year, which is nothing crazy, it's now boosted your net worth up to £460,000. Now, here's the thing. This is all completely tax-free under what's called private residence relief. You don't have to pay a penny in tax on any of that gain. I showed that number to a client once and they were like, wait, so I built wealth just by living in my own house. And I was like, yeah, exactly. That's money that she would have spent on rent anyway. Now, one massive caveat to all of this. I do not view the net worth of property as a productive asset. So if you've got pension and ISAs, They are semi-liquid things that you can use to generate an income from. But when you're looking at total net worth, doing this and paying off your home is actually a pretty good way to look at it. So think about this as a productive versus a non-productive thing, but actually in terms of total net worth, just paying off your main residence is not a bad shout. And if you're renting right now and thinking, great, this is all wonderful, it doesn't apply to me, it does. This is the pillar that just takes potentially the longest to start, which is exactly why understanding the other two, pensions and ISA, is even more important right now. So the maths works. The tools are there, but I would be absolutely lying to you if I told you that the hard part is the numbers, because it isn't. The hard part is you, okay? Which brings us to my next point, the psychology. This is where most people fail. Look, here's the uncomfortable truth. I have watched people with like better plans than what we've talked about today lose everything. Not because the maths failed, because they failed. It's almost always comes down to a couple of key things, right? The first one is something called lifestyle creep. And it is super sneaky and you don't realize it's happening. Here's how it works. Let's say you get a pay rise. You get an extra 400 quid a month take home pay. What do most people do? Of course, new car, better holidays, fancier dinners out. And then suddenly their expenses have risen to perfectly match their new income level. They're earning more, but saving exactly the same. Zero progress at all. The everyday millionaire handles this differently. They use what I call the rule of halves. So let's say you get an extra 400 quid a month. Look, give yourself a 200 quid present, okay? Enjoy it. You've earned it. But the other 200 quid goes straight into your future self. Bump up your ISA direct debit, increase your pension contribution, whatever you need to do. The rule of halves works really well. You'll probably never feel the pinch because you kind of never got used to spending that money in the first place. But over your career, those extra payments grow into something serious. Just one pay rise where you direct 200 a month into your ISA over 25 years at 6%, that will add a nearly £140,000 to your pot from money that you never even seen or missed. Now, the second thing is the ability to do absolutely nothing when your investments go a bit awry. And honestly, this one is the real superpower. So in 2008, during COVID, every time the market dropped by 20% or more, amateur investors panic. They log in, they see red numbers everywhere in their account, and they sell everything. They move to cash because it feels safe. But what they've actually done is lock in a kind of permanent loss. The 9-to-5 millionaire, they don't even log in. They know that market crashes are normal. They can keep that £400 direct debit running every single month. In fact, hopefully, they're probably quietly happy about it because now their £400 a month is buying more shares at a cheaper price. Everyone else is running for the exit and they are just walking in. Now, there's a third thing that is quietly eating into your wealth right now. And the government is counting on you to not notice. So the income tax banding, which is the level at which you start paying like different levels of tax, of income tax, has been frozen since around 2021. And the government have extended the freeze all the way up to, I think, 2031. So your wages go up each year, in theory, but these brackets, these limits, that they don't. So every year, more of your money gets pushed into higher tax rates. Now, the smart move is to use your pension contributions to pull your income back down below those limits. So, for example, if you earn like £55,000, you're about 4,700-ish over into the high rate of tax line, so you're earning above that 50,000, if you increase your pension contribution by about 400 odd quid a month, that will basically bring your taxable income down to below that line, and you've just saved yourself nearly £2,000 a year in tax and national insurance. Money that would have gone to HMRC is now compounding in your name for the next 20 years. Now, all of that's great. And everything I've just showed you, the pension trick, the ISA strategy, the psychology hacks, the problem is they all fall apart without one thing. It's not debts, it's not your income, it's not even the markets, right? It's a cognitive bias that affects over 90% of investors. And if you've ever made a decision based on how you felt at the moment, you've almost certainly done it yourself and have that problem yourself. It quietly sabotages good plans from the inside. And most people never even know what is happening. That is why you should really watch this video here, because I'm going to break down exactly what it is, why it hits smart people the hardest, and the one reframe that completely solves the problem. So give it a click and I'll see you there.